Collapse and comeback. In March 2023, a bank that had survived 2 world wars, the Great Depression and the 2008 financial crisis, ran out of time. Not over years, over a single weekend. By Sunday night, Credit Suisse, 167 years old, no longer existed as an independent company. This is the story of how the second largest bank in Switzerland went from a national institution to a rescue deal signed under emergency law, and why 16 billion francs of its bonds were simply erased. Credit Suisse was born in 1856 in Zurich. A politician and businessman named Alfred Escher wanted to build railways across the Alps, and the Swiss banks of the day were too small and too cautious to fund them. So he founded his own, Schweizerische Kreditanstalt, the Swiss credit institution. For most of the next century, it did exactly what its name promised. It financed track, tunnels, electricity, industry. It grew with the country, and it grew with something else: Switzerland's reputation for keeping quiet about money. In 1934, Switzerland wrote bank secrecy into federal law. Numbered accounts, discretion by statute. That reputation pulled in money from all over the world, and it made Swiss banks far larger than the small country behind them. By the 1990s, Credit Suisse was no longer just Swiss. It bought First Boston in New York and became a genuine global investment bank, trading floors in London and Manhattan, and a risk appetite to match. Then came 2008, and here is the twist most people forget. Credit Suisse survived it well. It refused a Swiss state bailout. Its rival UBS took one. For a moment, Credit Suisse looked like the smarter, steadier bank. That reputation did not survive the decade that followed. From 2015 onwards, Credit Suisse posted loss after loss. A restructuring, then another restructuring. Each new chief executive promised the last cleanup had finally worked. The numbers say otherwise. The losses had a pattern. Again and again, Credit Suisse ended up as the counterparty nobody else wanted to be. It was not one catastrophe. It was a decade of them, arriving faster than the bank could absorb. In 2013, the bank helped arrange loans to Mozambique, officially for a tuna fishing fleet and coastal security. Much of the money went missing. Bankers took kickbacks. The hidden debt was eventually exposed. Mozambique's economy went into crisis. And in 2021, Credit Suisse agreed with regulators to pay around $475 million and forgive part of the debt. In 2019 came something stranger. Credit Suisse was caught having a former senior executive followed through the streets of Zurich by private investigators. The affair triggered a public confrontation, the resignation of the chief operating officer, and eventually the departure of the chief executive. In 2022, a Swiss court convicted the bank of failing to prevent money laundering by a Bulgarian cocaine trafficking network. It was the first criminal conviction of a major Swiss bank in the country's history. March 2021. Greensill Capital, a supply chain finance firm, collapsed. Credit Suisse had packaged Greensill's loans into investment funds and sold them to its own clients, around $10 billion of them. The funds were frozen. Years later, clients were still waiting to be made whole. Weeks later, Archegos, a private investment firm run by Bill H. had built enormous leveraged bets through several banks at once. When the positions went wrong, the banks raced to sell. Goldman Sachs and Morgan Stanley got out fast. Credit Suisse was slow and lost about $5.5 billion. 2 disasters in 1 month from the same institution. An independent report commissioned by the bank itself blamed a failure of risk management rather than bad luck. In February 2022, a leak known as Suisse Secrets put decades of account data in front of journalists, including accounts linked to people who, reporters said, should never have passed a bank's checks. Credit Suisse disputed the conclusions. The damage to trust was done anyway. That October, a post about an unnamed major bank being on the brink spread across social media over a weekend. Everyone decided it meant Credit Suisse. Nothing had legally changed, but money is a confidence game, and confidence had started to move. In the last 3 months of 2022, clients pulled roughly 110 billion Swiss francs out of the bank. For the full year, Credit Suisse lost about 3 billion francs, its worst result since the financial crisis. In October 2022, the bank had announced yet another turnaround plan: shrink the investment bank, revive the first Boston name as a separate business, raise about 4 billion francs of new capital. It was the third major restructuring in 7 years. Investors had stopped believing in restructurings. Then the weather changed. In early March 2023, Silicon Valley Bank failed in the United States, then Signature Bank. Suddenly, every investor in the world was asking the same question: which bank is next, and how fast can I find out? On the 14th of March, Credit Suisse published its annual report late, after a query from American regulators. Inside was a phrase auditors use carefully: material weaknesses in its internal controls over financial reporting. In that week of all weeks, it was the worst sentence in banking. The next day, a reporter asked the chairman of Saudi National Bank, Credit Suisse's largest shareholder, whether it would put in more money. He said, "Absolutely not." He later explained it was a regulatory limit, not a judgment on the bank. Markets did not hear the second half. The shares fell around a quarter in a single day. That night, the Swiss National Bank offered a lifeline, up to 50 billion francs of emergency liquidity. Shares bounced for a few hours. Then the withdrawals continued. Reportedly, clients were pulling out billions of francs a day. Liquidity was never really the problem. Belief was. By Friday, the Swiss authorities had stopped trying to save the bank and started trying to dispose of it, with public money on the table to make somebody take it. What followed is the weekend that gives this story its name. Regulators, the finance ministry, and the central bank in one building. A deadline. A deal before Asian markets opened on Monday morning. And really only one plausible buyer, the rival across the square. UBS did not want it. It opened at 1 billion francs. The government pushed. By Sunday, the price was 3 billion Swiss francs, paid in UBS shares, for a bank that had been valued at around 8 billion when trading closed on Friday. Shareholders never voted. Switzerland used emergency law to cancel the vote entirely. And then the part that shocked professional investors. Credit Suisse had issued a kind of bond designed to absorb losses in a crisis, called Additional Tier 1, or at 1. About 16 billion francs of them were written down to zero, wiped out completely. Normally, shareholders lose everything before bondholders lose anything. Here it ran the other way. Shareholders received 3 billion francs of UBS stock, and the at-one holders received nothing. The Swiss regulator said the bond's own terms allowed it. Lawsuits followed, and some are still running. The deal closed in June 2023. The Credit Suisse brand was gradually retired. Thousands of jobs went. Switzerland, a country that had built part of its identity on having two global banks, was left with one, now so large that its balance sheet dwarfs the national economy it sits in. Every regulator in the world had spent 15 years building rules so that no bank would ever again be rescued in a panic on a Sunday. Credit Suisse was covered by all of them. When the moment came, the rules were set aside and the deal was done over a weekend anyway. So what actually killed Credit Suisse? Not a single bad trade. On paper, it met its capital requirements to the end. What it had run out of was the one thing a bank cannot borrow, the assumption that it would still be there tomorrow. A bank is a promise that you can have your money back whenever you ask for it. Credit Suisse spent a decade spending down the belief in that promise, scandal by scandal, apology by apology. In March 2023, it asked for one more day of patience, and the answer, for the first time in 167 years, was no. If you enjoyed this story, subscribe. New collapses and comebacks land 3 times a week.